The Hedgeless Horseman here. It's January the 14th, 2025. Um, First of all, thanks to the sponsors. Markets today. Metals doing okay. Crypto is up. Stock seems to be selling off a bit. What I find funny is, of course, that when I was going to say, I don't believe Bitcoin has any real tangible value except for in the long run, and that doesn't even just affect Bitcoin, but for whatever money laundering, transferring funds over borders, etc. Yes, there is a use case for Bitcoin and crypto. That's the thing. It's like when you say that, Bitcoin can be used for transferring funds, for example. I could buy Dogecoin. It's not like I'm transferring $10 billion. I could buy a stable coin. Could buy a lot of things. So it's not even specific for Bitcoin. That's the funny part. What is supposed to be specific for Bitcoin is, of course, that is quote the digital gold and all that, which I don't think is true at all. So at the end of the day, I do believe that Bitcoin is gonna be a catastrophe. I think pretty much it's gonna go to basically zero in real terms. Anyway, but the funny thing is, if there is no value, price is all there is, right? That it's a trading sardine, and you can see. This is kind of again, I'm not an expert, but this looks like quite a obvious kind of head and shoulders formation, and you can see how much fighting is going on in order for it not to break down. And if you're MicroStrategy, for example, given that you're basically running a pyramid scheme, you cannot really afford too much downtrend momentum, of course. That's the same for anybody with leverage, really. There's an interesting stock in Sweden, real estate stock, which was supposed to be the people's share, basically. And the CEO promised 100 years of increasing dividends, kinda, and they just leveraged and acquired, when rates were so low. Then the rates turned up. What was it, a year ago or something? And it went from being the kind of one second. What was the name of it? Here, yeah. Okay, it was longer than that, back in 2022. So it had just an epic run. Then the rates increased, and I guess you can see. The funny thing is, like, this almost actually top ticked to the day, along with at least this run in Bitcoin. So is there some correlation there in terms of appetite for risk and the effect of rates? Yes, I think so. Anyway, so they had just an incredible run, this stock. Got more and more shareholders in it, because of course when you see a performance like that, that gets people to believe that it's going to continue to doing that. And that's literally why vast majority of us tend to buy high, because we put a lot of emphasis what has happened already, and then project it. And that anybody who made a lot of money here, we want to make a lot of money like they do. And okay, they have made a lot of money in this stock, so I'm going to buy that stock as well. And then this happened instead. So yeah, and it was not a pyramid scheme per se, but it was a leverage play, kind of. More they acquired, and there was dividends, and obviously the rates were so low, the real rates were so low that you could, they were kind of funding themselves to infinity in a sense. Then all of a sudden rates went up again. Let's say hundreds of percent, and all of a sudden the business model didn't make sense. So it's down, I don't know, 90%, somewhere along those lines. On the run up, when you have a kind of a pyramid scheme, it's obviously very fun. This run here is just absolute bananas, and now we have, Bitcoin kind of driven by, well, not only by MicroStrategy, but you have Tether and stuff like that, real, weird stuff. But you obviously have the biggest champion being Michael Saylor and MicroStrategy. And MicroStrategy became a cult in 2020, or there was an article from 2000s labeling Michael Saylor as the cult leader of MicroStrategy, and then that bubble imploded, and so did MicroStrategy. And now he's back again, of course, in Bitcoin, doing kind of the same thing, going all in on one extreme momentum / hype thing, which happens to be Bitcoin. And now he's again almost doing some kind of pyramid scheme, where basically, as Bitcoin goes up, he can, let's say, print more shares and leverage up to buy even more Bitcoin, etc., etc. So it works great when the momentum is up. On the way down, however, it might happen like happened last time for MicroStrategy, basically that the company imploded and went down 95%. So obviously, if you're running that kind of thing, and it's basically one of the maybe major drivers of Bitcoin, the fact that, okay, as long as it's going up, MicroStrategy can borrow more money and buy even more Bitcoin, which in turn helps it going up further, and they can do the same thing. What happens when the momentum is to the downside? What happens if you have, Bitcoin basically suffers some of these, 50, 70, 80% declines like it has done all through existence. I have no idea. But so there's a big battle here, obviously, that some people are trying their hardest not to have this become a fully fledged head and shoulders formation, and it closes down here, because then all the traders, and there's a lot of traders and a lot of leverage and a lot of stop losses, can't really afford maybe to have this break to the downside. So who knows, maybe MicroStrategy are printing like crazy, or leveraging up as we speak, just to keep it from falling down there. And I think this kind of shows just how fragile it's becoming. I don't think it's at all the same circumstances compared to when Bitcoin was really a fringe niche kind of thing. Yeah, it was probably leverage and all that, but not the same type of leverage. MicroStrategy wasn't in at that point. Again, I think the risk profile is totally different now. Now it's kind of suggests that tensions are getting higher. I would say tensions are much higher at that top than was at this top, or whatever, any of the other tops back here, for example. Not as much at stake, not the same structure, not the same institution. It's almost like, well, I'm worried about Bitcoin being kind of a moral hazard type situation, where so many people are in it. There's like the housing market in a lot of places. When the housing market starts tanking because so many people are leveraged and so many people are speculating on it, so it's like that's also voters basically. And of course Trump appealed to the Bitcoiners in this election cycle. Now though, of course, the election cycle is over. But I'm watching. I still don't own any crypto. My thesis for Bitcoin and basically all cryptos is that their intrinsic value is zero, and will hit that in real terms, basically, sooner or later. Anyway, I just find it fascinating again. That's like it's obviously a big struggle here, and someone obviously does not want it to close below wherever the neckline is. So I don't know. Maybe it's they can keep momentum from turning down and it goes up again. It's like I don't know. This is way too risky for me anyway. Let's look at some other stuff. Brixton Metals sure has taken a lot of punishments or a punishment, and of course, I mean, how what could explain that? Let's say. I mean, the worse a chart gets, the more people just want to sell out. Couple that with tax loss selling season. Couple that with the fact that their exploration is expensive. So I mean, the more assets come out, the closer we get to a new financing. And as I've talked about that a long time, I mean, especially during lows or whatever, when it tends to be, bear market sentiment, when it tends to be hard to get something to go up, people focus on risk more and more. People see, people focus on what are the risks to the downside more than they focus on what the risks are to the upside. And when you have these circumstances, and you have a case where they haven't, let's say, put out a barn burner hole from this season that can really, let's say, punish the. I'm not gonna say there's almost a million shorts, but it can't really punish the market in a sense because there's not enough buying power and there's too much selling pressure. What is interesting, and again, it's like here they put out the Brixton Metals Pride results from Ivanhoe's Electric's 2024 drilling at the Hog Heaven project, Montana. So they apparently leased Ivanhoe Electric's leased further 5,000 acres of private surface and mineral rights. So they've expanded the land position. They have yet to really have 9.5 meters or 2.17. I mean, you're not making a mine obviously at that depth with those grades. Here we're talking a bit, 100 meters of 0.4 CU equivalent. That's getting interesting. So I don't know if when they lease the land necessarily, but it seems that Ivanhoe Electric has not given up on this project as they have leased land. So I would expect them to keep drilling. Let's see, drilling continues to deliver, highly encouraging. So they might be close to something. That's the tricky part about these porphyries. As we've gone through in like inflection, whatever, that down in the Macquarie Arc, you can be really close to an ore zone. But it's like if you're 40 meters away, you might only get trace mineralization kinda, and then 40 minutes away from that into the actual higher potassic core, higher grade core, all of a sudden you get a whopper of an intercept. So to me it looks like this is still ongoing, that Ivanhoe is exploring, and that again, just looking at this is obviously very anomalous, and here we have some 680 meters of 0.20. That's not ore grade, but still, this doesn't drop from the sky, so it looks like there's a huge low grade halo. Question is there an economic porphyry at depth? And if there is, will Ivanhoe find it? And if they do, how long will it take? I can't answer any of those questions. We just know that the prices of these could be absolutely huge. Otherwise, Ivanhoe wouldn't be drilling for them, obviously. And Brixton, I think, would keep 25%. What is priced in? When you account for the other stuff they have, maybe. Well, that's hard to say. You could say that, hey, they're their Camp Creek project or their Thorn project alone, the potential alone is worth more than this. So in that case, there's 0% chance of success priced in, zero success priced in for zero success priced in for Ivanhoe Electric. And then, of course, the funny thing with risk reward and the investing speculation being Schrodinger's cat is the fact that if Ivanhoe Electric does not end up making an economic discovery that will be of material significance for Brixton, then it looks like the market was right, regardless of how if it priced in 0% chance of success. I mean, common sense suggests that if Ivanhoe Electric is working it, to say that the world's experts in porphyry exploration have no idea what they're doing and the success chance is actually zero, I mean, to me that makes no sense. So that's what's funny about this sector investing, in a sense that even if you have, let's say, well, Brixton kind of has three major partnerships in a sense. They have BHP, who has funded them for Thorn. They have Ivanhoe Electric, who is working Hog Heaven, and they have is it Centerra that struck a deal on the Eitling Goldfields. All of those companies wouldn't be doing that if they didn't think there was a possibility of making $1 billion discovery, etc. Still, if Brixton at 30 million, for example, let's say none of those companies end up making any significant discovery, and for whatever reasons, I was gonna say, let's say, I mean, it's impossible to kill all the potential in a project as big as Thorn, and I mean that goes for Eitling Goldfields as well. But like, for theoretical purposes, let's say within 5 years from now, it's like in the next 5 years, they don't have anything to show for it really. I mean, despite the fact that they might have explored 1% of the total land package, but for all intents and purposes, let's say they fail on all. Then, of course, it might look like the market was right at any valuation. I mean, there's no valuation that is low enough, because if you look at what happened, it looks like the market was right. It priced in 1% chance of success, let's say, per project, and I mean, it's just common sense that that's almost impossible given that you have these types of players, BHP, Ivanhoe, and Centerra. I mean, are they, I mean, enough that one would be, let's say, stupid, which is probably a stretch, but imagine that all companies are actually stupid and everybody should have known that there was, almost zero chance of success. So I don't buy it. So that's what's interesting about the speculation in this sector overall, that the market can be, in a sense, very wrong if we're talking about speculative value, like risk-adjusted value. But it can also look 100% right, depending on what happens. Obviously, if we're at this market cap and Ivanhoe Electric drills a monster hole at Hog Heaven, for example, this market cap is going to look insanely wrong, and the stock is going to go up a lot. Do you know that? No, absolutely not. So again, my point is nobody really knows. But this is just basically, I'm just airing thoughts about speculation. That's why also it's important not to take everything personal. I mean, again, it's like when you understand stuff, when you understand that nobody knows the future and everybody just have, guesstimates, probabilities, and price. That's basically what we have to go on. No stock would become a 10 to a 50 bagger if everybody knew it was going to become a 10 to 50 bagger. I mean, if the market knew that Great Bear was going to get sold at, what was it, like 1.8 billion, it would be trading at 1.6 billion when it was actually trading at 700 million, for example. So that's the thing, like nobody knows. exactly what's going to happen. And that's why asymmetrical risk reward is so important, and just having a sense of probabilities, let's say. Because I could say that, hey, I think there's whatever, let's say there's a 10% chance of Brixton Metals, either with the help of BHP at Thorn, or Ivanhoe at Hog Heaven. Take those because those are simpler in the sense that if you make a big porphyry discovery, that's more of a shock to the market than if Centerra, for example, put out that, was it Centerra? I'm not sure. Hit some gold mineralization, for example. If you hit the most impressive porphyry hole is going to be much more of a shock than the most impressive gold hit. Typically, and of course we know that porphyry deposits can be worth billions. Gold deposits can as well, but they tend to need in a sense, a lot more drilling. There's porphyry deposits which kind of get delineated from 9 holes. You can't do that with most gold deposit, let alone lode gold deposits. But let's say that if you think there's a 10% chance of that happening, and you would figure it's like, oh, in that case it's whatever, going to be worth $2 billion in the next, let's say, 5 years. Yeah, if you thought there was a 10% chance and you thought there was a 90% chance of failure, from that perspective, then Brixton Metals would be cheap, but there would still be 90% chance you would end up losing money regardless of how cheap it is. So majority of the time it will look correct no matter how lowly priced it is. It's just in the 10% of cases you're gonna make a lot more money than you should, let's say. But again, in 90% of cases it's gonna look like the market was right all the time. It doesn't matter how cheap Brixton was. If Brixton went down to 15 million and then in 5 years they end up proving up nothing, it's gonna look like the market was right all along. It's only the exceptions, meaning discovery success, that's going to make a 50 million or 30 million market cap look very wrong instead. But yes, now I'm going off tangent, but I do think that is those are important things to consider. And again, why? There's so many unknowables that you can't really, you can't really say if you did a right buy or a wrong buy, especially in a high risk, high reward story, simply based on the outcome. Nobody knows. That's the thing. If you own something, I made money on stuff I had no idea was going to make a discovery. I lost money in stuff I thought had a good chance of making a discovery. So the question is then, was it a good buy because I made money on one, and was it a bad buy because I sold or lost money on one? No. That's not necessarily true. I would argue that it was, let's say, almost complete luck in the case that it went up, because I hadn't even considered that I could do a discovery like that. Whereas like the one I lost money in, maybe I would have done that bet again if I had the same circumstances, because I thought the chance of success was 30% and it was pricing in 10%, for example. So I thought it was on a risk-adjusted basis 200% undervalued. That still doesn't change the fact that there was a 70% chance of looking stupid. But you can't let that affect you too much, because then you get kind of gun shy. But also you can't just, there's so many factors to price in or to consider with high risk, high reward. But now I'm gonna get to my point. My point was that we know that it's impossible that the Thorn project, for example, it's pretty much impossible that it's not undervalued, I think, from a pure exploration standpoint. So what's interesting is going to be, like Quinton talked about in his Crescat presentation when he was discussing Brixton, whether BHP, world's largest miner, when they go exploring, I don't know how many rigs they would like to have if we're talking, the type of project size that Thorn has. There's so many targets to test. they still need to, I don't think they've, killed off Camp Creek either. I mean, the main porphyry, the flagship target, because they can only do a few holes per year with their, a junior budget. Um, the question is, what does BHP think? I mean, imagine now, for example, you have, sentiment absolutely in the toilet. We're into a new year. Obviously, if they want to do a big drill campaign, or big for a junior, or big in terms of money spent, because it is expensive exploration doing deep drilling up in BC, they will need to finance again. And last time, I don't know how much they financed, but let's say they took in 15 or 20 million. I mean, that's half or more than the current market cap. That might be a hard sell, especially since sentiment has also gone down, for better or for worse. Then the question is, what could happen if the market is pricing in this? It's like, the next, if they want to have a shot of putting out a barn burner result this year, they will have to raise a lot of money, so they give themselves a few tries, so they can afford to drill several holes in order to get lucky. Well, then they need to finance, and that's what typically the market, tends to price in the next, let's say, quote, material news release, which might, in this case, as far as the market is concerned, be financing, a very dilutive financing, let's say. But what if Brixton, like Quinton aired, and I think I've talked about this before. I mean, what if they're do a deal with BHP? It's like, okay, here, you spend whatever money to get 51% ownership of Thorn, and then we get a whatever. The next stage is to put out a PFS, let's say, and then you get 75%, kind of like whatever Headwater Gold and Inflection Resources type of deal. A PFS on a porphyry would cost hundreds of millions of dollars to get there, and you get to you're free carried up to 75%. If they would take it that route, obviously, if BHP does a PFS on a project, then they believe it's going to be worth multiple billions of dollars. Otherwise, they wouldn't bother. So that's what's going to be interesting actually with Brixton. They might keep on just we're going to raise. Maybe they do a smaller amount, whatever. So let's say they raise 8 million and they can afford to put out X amount of holes. Okay, that's going to be, again, pretty dilutive, but at least the market cap isn't that high, so if they have success, it's still going to be very material, but it's going to be dilutive, and then they get themselves, let's say they can afford 6 holes or something. Then we're kind of, we're stuck in that kind of cycle. There's like the dilution cycle where it's like they need to hit something that really punishes how sour the sentiment is on the stock. Otherwise, they will have to redo the same thing, regardless if they actually keep adding value in the sense that they keep hitting, decent to pretty good results at Camp Creek. So it's growing, but nothing that makes the, let's say, retail market really excited. And obviously BHP is already in there. So it's like, I hope you get my point. So that's a possibility. That's a scenario where they do another financing. They try to go it alone again. 100% ownership, trying to get that shocker of a hole that really wakes up the market, really punishes the perceived undervaluation. Otherwise, it might just keep doing the same thing, because they could keep raising $8 to $15 million this year, next year, whatever, and they never reach that point where it's like they have this obvious success. The market starts to believe they're onto a $1 billion payday, for example. But there is also the scenario where they're like, okay, we would have wished to have 100% ownership, make a discovery, and or I should say, put out holes that the market really cared about, and this would become the next Philo mining, and you had 100% ownership, and everybody made out like a bandit with a $3 billion payday. I mean, that's obviously the from a greed perspective, that's obviously the dream scenario. But they're like, okay, maybe it's time for BHP, if they're willing and able to, like, okay, you can take over this project. You have endless, infinite pockets, endless pockets. You could put 5 to 10 drill rigs here, and we're gonna be along for the ride. If you end up finding something, let's say we're free carried up to 75, or yeah, you free carry us, you get 75% ownership. Obviously, a 25% of a BHP size price is an enormous amount of value for a company that's sitting on 30 million Canadian. Because you can, or one could just assume that BHP would at minimum want to see a $3 billion project. Probably actually higher, given the fact that I think their market cap is above 100 million. So even a $3 billion project would only be 3%. I don't know if that's even worth their time. Not 100% sure. That's an exciting thing. So it's like I actually added a few today. But Brixton is a high risk, high reward case. So it's like the main determinant of position sizing, the way I see it, is the risk side of things. How likely are you to get your money back or more? I mean, how much margin of safety is there? Brixton has a lot of potential, like three-pronged potential with three, mid-tiers to super majors, but it's potential still. So there's no guarantees that there will be really anything of tangible value to that will get monetized. So it's speculative. They have a lot of kicks at the can of multi-bagger potential, but it is still potential. But that is what I actually find interesting, and that's actually why I added a bit. And it's like not a big amount, because again, but I like high risk, high reward situations, but I have to diversify across many of them, because most will obviously not see the high reward side materialize. And with these cases, if they're cheap enough, you obviously don't need a big position for it to materially have an impact on your portfolio in case the exception happens and they actually throw up a monster, for example. And if they don't, it's not really a big deal. I mean, let's say you have 1% of your portfolio. If that gets cut in half and before you sell, for example, I mean, it's basically being cut in half since the last time I added, but it was never a huge position anyway. So it's like, would I like to have that money? Of course. Would I like them to have made a discovery? Of course. But now we're in a new reality, a new price, a new year. And I think maybe, again, that this situation, the market cap and the new year beginning, that it might, the company might feel like, hey, it might be time to rethink things and actually offer BHP an earning deal, let's say, on Thorn. It's like, okay guys, you take over, you bring in 5 to 10 drill rigs or something, go at it, but we want whatever to keep 25% free carried if you end up making something that you want to push forward, or if you make Camp Creek or any other discovery be a BHP sized price, because that would still be incredibly material for a 30 million CAD junior, and you can let go that like insane financing pressure, at least for Thorn. And we know that, I mean, Hog Heaven is already carried by pretty sure it's still free carried by Ivanhoe. So in that sense, you might almost be totally eliminating the dilution risk, but you still keep significant upside potential. Because let's face it, if Brixton had 100 million market cap and they had 100% upside because they own the project 100%. Let's say it goes to, let's say they 100% own a project. It gets sold for 3 billion down the line. I mean, that's their payday. Okay, that's a 30 bagger. Okay, but let's say they do a deal with from this market cap and they let BHP take it over and BHP proves up a $3 billion payday. And let's say, I mean, to make it, to prove my point, let's say Brixton is free carried up to 33%. Or they keep 33%, but they're free carried, PFS, whatever. And the total sum of the pie is a $3 billion price. They get to keep 1/3, 33%. That's $1 billion to Brixton. From this market cap, that's a bit more than a 30 bagger as well. So you get my point here. It's like the new reality's price is much lower than it used to be. I don't know exactly, I mean, what they might have peaked at, let's say around here. Let's say it was 100 million. Okay, here you had 100 million, 100% ownership of Thorn. Now, much lower share price. New reality, new price. Let's say they give away up to 67% of the project. But again, given the reality of the new starting price, there might still be kind of the same return potential that you had up here. And I know, you know, the idea that, well, I mean, if you have a, whatever, 80% loss, is going to take 400% just to get back to even, and that's the stuff you see all the time. It's like, yes, that's also very true, but at the same time, given the asymmetric risk reward, the winner share, let's say you have a 5 bagger, for example, or it's like $1 turns into $5. That's $4 profit, which would pay for 8 cases that got cut in half, for example. So let's say you started off with a 1% here. Now it's down to 0.2%, let's say, of your position. And then maybe let's say you double that to 0.4. And in this new reality, assuming they make that kind of a deal, you still have a shot at, let's say, a 30 bagger in case BHP takes it over, find something $3 billion plus, Brixton gets to keep 33%. So you lost 0.8% from your initial bet. You quote double down, take it up to 0.4%, and let's say that becomes a 30 bagger. I'm just obviously making up numbers here. It could become 0, it could become a 10 bagger, 20 bagger, 5 bagger, 30 bagger, 50 bagger. You never know. My point is that then that 4.4% position, same case, if they have success from this level, you would end up still making more money on Brixton, and it would pay for the 0.8% loss you got from your initial bet. I hope people understand my point about this. There's like cases changed all the time, the risk reward changed all the time. Like for example, Magna, it ran up to what it was at $1.5, then it retraced all the way to 40 cents, which I thought was absolutely crazy. Doubled down there, and in a sense made even more money. It took longer time, but ended up making kind of more money with the stock being at what, $1.6 or something. So yes, I mean, would I wish that it didn't retrace to 40 cents? I mean, it would feel better, but at the same time, it's like that opened up. I think it actually was a better case at 40 cents, what was it, a year or two ago, than it was at maybe 33 cents when I first wrote up the story, for example. So it's like my point, in a sense, is you cannot predict everything that's going to happen, but it's our job, in a sense, to react to the opportunities that are evolving from Mr. Market. The what news is out there, the sentiment, yada yada yada. That's my point. So, whereas I mean, it doesn't change the fact that this is obviously not a good-looking share price. Um, Development, but that doesn't mean that necessarily it's like, okay, well, if that's the past, uh, that's all said and done. No, that's not necessarily true. So that's just what I'm saying. I'm not saying, bet the farm on Brixton, or I'm not pretending like this is a uh, you know upward sloping share price, and that everybody's just cheering the fact that the stock price is down 75% or whatever. I'm just saying that uh, we've come to an interesting point in time, price wise, and again with the new year, that I'm open to the possibility that Brixton might feel the need to let maybe BHP earn in. But there's also a possibility that BHP doesn't want to earn in. And if they don't want to earn in, maybe nobody else wants to earn in. And then Brixton will need to finance it again. And let's say BHP or whoever doesn't join in the financing, so that's going to have negative signal value, that it looks like BHP, they have, of course, the highest threshold for success. Uh, but still, you know what I mean? I'm trying to be devil's advocate here. So I'm saying I don't know exactly how this is going to turn out. Uh, but I think it's at an interesting spot at 30 million CAD. And I think that there are potential scenarios which would make the current price kinda very interesting. What the odds are of those scenarios happening, I have absolutely no idea. But yeah, I started to nibble again today. Uh, High risk, high reward as always. Well, as always. Uh, so I recently talked about Amex Exploration on K Report. I've talked about this a few times, I think. So Amex, what was interesting with Amex is like it. I mean, this entire graph is almost, a bear market. So it might not look like. Well, Amex hasn't done too well, let's say, but yeah, actually they did. I think the story started taking off here. I mean, 2018. Of course, going up to 2020. So during this period, there was also a bull market, well, a bull leg in juniors. So that everything skews everything in a sense. Obviously, that's like, okay, it's probably been gone down much more than if the market wouldn't have been in a bear market here, and it probably went up more than if the sector wouldn't have been in a bull run, of course. But still, they made their discovery, whatever. So Amex actually was one of the best performing stocks for a while. I mean, what was it, 8 cents, 7 8? Wow, okay. So points or 6 cents up to $3.5 and stuff. $4 actually. So it was one of the best success cases. I remember it's like I followed it. You couldn't help but notice the news results they were putting out. High grade, high grade. I didn't look into the story too much. It was kinda popular. It was kinda hot. It was a performer, meaning it's like, okay, everybody almost everybody was aware of the project. It was in Canada as well, which typically demands a premium because, I mean, I think Canadians and North Americans overall, they put a premium on Canada, for example, relative to other places. But it never felt really that I didn't feel like I would have an edge in a sense. It's like what can I find that the market is missing? Let's say because they put out good news and the market was appreciating said good news. It wasn't a misinterpreted case necessarily. So they put out good news, but they were also rewarded for it. So it's like, in my view, I mean, even though I didn't know too much about the case, it looked like, yes, they're putting out good news and the market is aware of the project being good, let's say. So it was appreciated. So it's not, I didn't see an obvious price to value gap just looking at the sentiment, let's say, and the interest and all that. But that changed in a sense. So share price on September 3rd was 1.89. They put out their maiden resource. It basically got cut in half. Price of the company went down 50%. Why? I mean, I tried to figure out because anytime I see huge price reactions, that's of interest to me, especially price declines during a bear market, because companies tend to be cheap for starters, and still investors are very sensitive to negative surprises, let's say. I mean, this, stuff like, or the saying, the straw that broke the camel's back. I mean, it might have been cheap, but it's like, it's been in a downtrend. Not really a downtrend perhaps, but it's like, okay, it hasn't gone up 5x over this period of time, so people are already getting somewhat bored in a sense. And then they have a negative surprise and people just get disgusted by the sector, and they get collared by all the other holdings that are probably down more, and they're just, oh, F this. It's like, I'm getting out of this sector. So price declines tend to be exaggerated during, obviously, bear market sentiment, and they also tend to be starting off at maybe a low price to begin with. So it's like, okay, even despite the fact that it was an underwhelming MRE, maybe it should be priced at, I don't know, $1.8 or whatever. I'm just throwing some numbers out there. But it's like, okay, in this sentiment, negative news, people capitulate in a sense, bam, minus 50%. So why I think this is interesting, I think, well, they put out a PA, for example. Let's see here. So first of all, yes, the MRE was smaller than expected. I think people were expecting maybe a total resource of like 3 million ounces or something. And I'm pretty sure it came out that measured indicated. So what's that? So what I'm actually not 100% sure about is if the total resource is 105 million ounces, and if this is in addition, because somebody said it was 1.6 million ounces. Regardless, okay, let's look at the economics. So this is a PA study. After tax NPV, base case $2,000 gold, 525. Very good IRR because the initial capex is so low. Where is the key? $229 million, I think that's Canadian. And expected margins were, yeah, so US 807, life of mine all-in sustaining costs. I mean, that's obviously very impressive, assuming it would get close to that. Even if it would be like, I don't know, 33% higher, it will still be quite high margin. I mean, compared to most mines out there. So the point is that it looks like it's, for now, I mean, the PEA put out relatively small operation, but low capex, expected to be high margin, yada yada. So that's like, let's say that's the bird in the hand in the sense. It's like 1 million ounces of what looks to be very profitable gold production. So that's forms the margin of safety. And the MPV obviously at whatever spot $2,600, it's 914 million, which is what, 8 times the market cap right now. After tax IRR 60%. So again, I mean, if the gold prices are at this level, you put this mine into production, should be incredibly profitable. It should be worth, in that case, around 914 million. So that's again the bird in the hand, a robust small-scale project kinda. The thing is, of course, that they have a lot of exploration potential, and they did put out a news release about that, where they hit high-grade mineralization and a lot of zones, and they have a lot of schematics. They have a lot of slides, as you can see in the presentation. Gratien gold zone, 1.44, 45 of 67 grams per ton gold, etc., etc. So, and this, you know, looks wide open. Open additional gold discoveries, E2 gold zone, yada yada. So it's like, if there's one thing I truly believe, is that the more they drill, the bigger their deposit is gonna get from, let's say, multiple zones, plus infill drilling, plus just drilling around the current resource, for example. I think they have that in the news release here. Oh yeah, they found a new zone with visible gold. That was the first. I mean, here, for example, okay, 45 meters from existing PA stopes, 60 grams per ton over 0.7 meters. Again, it's like drill a few holes around here. You never know. It's like, I mean, my base case is that this is the PA, the MRE. That's a snapshot view of what is at least gonna be here, let's say. And I think this is simply a project that's gonna become bigger the more they drill. Simply by the fact that they have so many zones, and they've hit, you know, high-grade gold in a bunch of other places. So I would expect open at depth and to the west. Yes, so I would expect there to be a lot more gold here than this MRE is suggesting and the PA is suggesting. Hence why the CEO, in a recent interview, it might have been with Crux, where he says that, you know, they might be putting out a new resource estimate and a new PA at the end of this year. Why would you do that? Obviously, because you expect the resource, I mean, from drilling, you expect the next resource to show that there's even more gold, and then redo the PA showing it's an even bigger project, right? That's the only way to make sense of that, because if they didn't think it was gonna get bigger, or they could add more ounces, why would they be so quick to, I mean, within whatever, almost like, you know, 12 months, let's say, put out a new resource estimate? No, that's suggesting they think there will be, you know, there's a good potential for significant improvement in terms of endowment and scale of the project. Which puts Amex, in my opinion, in a very interesting spot. I mean, we know Eldorado Gold, they put in more money after the MRE, might have been after the PA even. So it's like, okay, we have fresh vote of confidence from Eldorado, and obviously they do their own modeling. So it's like if the resource if the resource modeling, for example, was maybe, you know, way too conservative in a sense, Eldorado will have their own estimates anyway. They have probably have access to all the data, etc. So they put in more money. That's suggesting they like what they see. They like the project. They still like the project. And again, couple that with the CEO's comments where he's suggesting that this is indeed gonna get bigger and better, maybe significantly so, and to be shown on paper within 12 months. Then we're in a very interesting situation where it's like, okay, the bird in the bush, and to quote the CEO, I already know I have a mine. So this PA suggests that, hey, you have something worth mining here, so that's tangible success to the tune of, let's say, 900 million at today's gold price. And given where it's located, given the jurisdiction, I think this is also going to be a mine. I think this could be very much get built, let's say. I think the communities are pro-mining. It's Quebec. It's one of the best jurisdictions in the world. Probably have cheap power, yada yada. So then, to me, the obvious case becomes, because I don't, again, I don't think there's, if you have cases that are shorter than, let's say, whatever, 3 months, it's like, oh, the very next news release, I don't think you typically have a case. But I could make a case that, okay, we know what the market cap is now, 132 million CAD. Okay, on paper at spot, the, let's say, conservative resource is showing 900 million of value, 540 whatever at $2,000 gold. So this should be a project that works very well at $2,000 gold. So $600 plus margin of safety in that sense. That's the bird in the hand. So then the question is, let's fast forward 12 months. Let's say they've done more drilling. Let's say they've taken in more money. Let's say the market cap is, they take in whatever, $13 million or something. So from this point of view, the new market cap is 145 million Canadian. And then we fast forward 12 months after a bunch of news releases have been put out this year. Let's say they put out 15 news releases from now and year end. And let's say they do a new MRE and a new PA. Maybe the MRE is going to show whatever, 50% increase in ounces, 40% increase in ounces. Let's say the project economics gets much more better, and it's like, oh, let's say 40% better, whatever. Okay, and let's not even account for a higher gold price. Is there a reasonable probability that this project will look significantly better on paper in just 12 months? I think there is. I think that's what the CEO is suggesting, and we know that Eldorado recently invested more, so they like it, and Eldorado wouldn't really give two shits about a project that's probably worth 132 million, obviously, then they wouldn't even be investing in it. So we know Eldorado thinks this is cheap and has potential, and we know the CEO thinks that this is going to get maybe a lot bigger and maybe relatively quickly. Then I think we have a pretty good risk-reward case, because it's not going to get, let's say, at face value, it's not going to get worse. And if it's already worth 540 million on paper at $2,000 gold, let's say it's 900 at today's gold price, that's a pretty good margin of safety. That's like, if we believe that this is a project worth putting into production already, and there's like whatever, 90%, I'm coming up with a number, 90% chance that it's going to get even better. So what's the risk reward there? It's like, okay, if there's a 90% chance it's going to get better, that means there's a 90% chance that whatever we're buying now is actually gonna be worth even more in 12 months. Let's say that's $1.2 billion or something on paper at spot, or $2,600, or like 600-700 million at $2,000 gold, whatever. This is probably gonna look unsustainably cheap. I doubt if they put out a even bigger MRE, even better PA. I don't think the market cap is going to be at this price, assuming gold hasn't like crater or something. And we know again it's in a safe jurisdiction, uh, where I mean, and especially since there is a possibility that let's say within 2 years, this project has a resource of 3 million ounces, and literally is like, hey, this could be when let's say still wide open in a lot of sense. Um, then it might be one of those kind of stand out that's like, hey, this is a project in Canada, in Quebec. It will likely get built because it's in a favorable jurisdiction and location. And it's multi-million ounce gold deposit, with a lot of it, let's say, being high margin gold, which companies will put a premium on, and the location, all that, put a premium on. And if it's a 3 million ounces, with a high quality project, that's quite rare in this sector right now. Quite rare, especially in tier one jurisdictions. Um, I mean, back whatever, I don't know what the market cap was here, for example, but I would guess around at least 300 million. And I mean, if they thought, and that this was at a much lower gold price. So whatever the market was seeing back then, let's say put a 350 million market cap, they obviously thought that it's going to be worth probably $1 billion down the road. I mean, is it impossible that this project is actually $1 billion project? I don't think so. I mean, on paper, at spot gold, it's already around $1 billion project. Let's say that they do end up proving it's whatever 2 to 3 million ounces within the next 2 years. Should one be surprised that if this had a market cap of, well, probably it would already be bought out maybe, but yeah. So I think the risk reward in Amex is actually very good. It's like when I'm thinking of what could go wrong. I mean, when is 1 million ounces of allegedly high margin gold in Quebec, Canada, gonna be worth, let's say, a lot less than the current market cap? I don't really see a high probability of that happening, but I see a high probability of the project getting better. Yeah, so I bought a bit here, and I've added some. I'm actually thinking of, I added some for the hodl folios as well, because I really like this kind of margin of safety plus, in a sense, free optionality, especially if I think the free optionality quote is in the form of probable growth. So if they find maybe 2, 3, 4, 500,000 ounces more, or not even that much, I mean, that could have already considerable impact on the economics and value. Yeah, so I mean, again, it's like, this is not a buy recommendation or anything like that, but I think if you think about it, I think one could certainly make a case for even just in the next 12 months, and that's almost I'm not going to say short-term case. I mean, most people consider short-term case that's like the next news release a week away, but in the grand scheme of things, I mean, if you have a pretty solid risk reward case for 12 months, that's not a lot of time. I mean, my long-term goal has been to compound at 50% per year. So it's like, do I see there's actually a high probability of Amex delivering at least 50% in the next 12 months, even without the help of gold? I think that's already a solid case. And so I like the risk reward in this, with emphasis on the, as I see it, low risk and probable upside. With even, I mean, I think one could say that it's still high potential upside, because they might make even more discoveries, or one zone blows out or whatever, or the new VG discovery might be turned into whatever, a repetition of what their high grade zone or something like that. So there's certainly different ways for exploration upside, and you can, I mean, pretty much see that here. 1, 2, 3, 4, 5, 6 different zones. This is actually a bulk intercepts. at vertical depth of minus 500. So it's like, okay, 500-meter depth. In a bulk mining scenario, this might work, but then you probably have to have quite a bit of it. I mean, there's long hole open stoping mines that have this kind of. I mean, especially if this would be true width, that's pretty okay. But otherwise, yes, okay, this might not be that impressive. 21.12 over 1.5, vertical depth of only 20 meters. That's in the JT. Gratien, 5.7 over 3.8. That should be economic. 7.44 over 2 meters, including 12 over 1. That's probably, I would think, I don't know what the mining width would exactly be. What's the cutoff grade? Stop constraint 1.29 grams per ton. Okay, that's the cutoff grade. That's a very low cutoff grade. I think that's again thanks to the location, etc. And I think they have cheap hydropower. For Canada, this is a very low cutoff grade. So then this should be very much economic. This should be economic. That should be economic. This should be economic. This should be very economic, etc. So it's like, I mean, these are all different zones. If they just keep adding, if one assumes that most of this is actually economic, then yeah, I mean, imagine, okay, give them 10 million, and I think Quebec drilling is cheap. Okay, 10 million, they can maybe drill, I don't know, let's say they can drill 20,000 meters with that. I mean, how much will the resource have grown? So, okay, you spend 10 million, maybe you throw up like 200 million in terms of added value. I mean, that's a 20x return on investment. I'm not saying that's going to happen. I'm just saying that, I mean, there's obviously potential for that kind of stuff. Osisko Development. This is one I started to. Well, I've watched this in for some time as well. I actually think this is a very interesting case, and I have nibbled in this as well. I'm doing more work on it. I actually was in the financing around here, so that's I don't remember what was the price of that. I think it was this one. US $1.8. So I think that would be, I don't know what that's in Canadian, 2.4 or something. So I'm red on that placement. When is I don't know when the holding period is. That's the stuff I never really cared too much about. I know some who's like have, and I probably should have better, a better sense of when there might be people, selling when shares come free trading. Since it's not really material for the value and stuff. If something is cheap, I just buy, and then if there is some people who sell something that I think is cheap just because they want to keep the warrants and stuff, and I mean sometimes I do that myself. I don't really see it as a big problem because there's a chance that it won't be selling, and if I didn't buy because I was expecting selling to make it even cheaper, I mean then I'm kinda in a sense making a mistake. Because let's face it, if you bought it and it sells off but you bought it cheap, I mean if the base case plays out, you're gonna make money on that buy anyway. But if you didn't buy and you expected, there's 200% returner over 2 years, you didn't buy because you thought it was gonna get cheaper with the holding period being up, and it doesn't get cheaper. I mean, you actively did not buy a 200% expected returner, so you kinda said no to case like that. So that in a vacuum, that's a mistake. So it's basically you're risking not capturing a very good, let's say, expected return in hopes of getting an even better expected return. And a lot of times that might work, but in a vacuum, that's still being greedy or gambling. That's like you're gambling with, let's say, returns in the hand versus potential returns that could be bigger. I mean, like this example of, you find a $100 bill on the street, but you're not going to pick it up because you think you're going to find $200, whatever. If you don't find $200, you just left $100 on the payment. But anyway, I think this is actually a quite interesting case. I mean, also one of those cases where it's like, I mean, last 5 years, this is a very horrible chart, of course. I mean, if somebody bought, well, I mean, anytime from 2021 to whenever almost, I mean, you're going to be sitting at a paper loss. So going back to the Brixton case, in a sense, that's like, okay, we know the share price performance has been very bad, but the past is not really important, except for, I mean, if you can figure out whatever tendencies that would make today's price look expensive too. But when I start digging into it, it's like the CEO says, Sean Rusen, that they have around 130 million in cash, 25 million, I think that's Canadian. They have like 25 million USD in debt, so let's say that's 30 million CAD, so around 100 million in net cash. Okay, then the enterprise value is 200 million. And apparently they've drilled some 800,000 meters. I don't know how much that cost, but let's say I think it cost a couple of $100 million. So that's sunk cost now. I think they have like 50 million in mining equipment or something like that. 30 million in infrastructure value, or if it's the other way around. But there's just a ton of sunk costs in it, and sunk costs are not valuable per definition, because you can spend $1 billion on something that's worthless. That doesn't mean you're getting $1 billion in tangible sunk cost. Obviously, I mean, if somebody dug a hole without having a mine or a deposit, just some guy just blows $1 billion in digging a hole, that's not cheap, even if it costs 100 million, and it would take 10 times that to redo it, because that hole is worthless because it's just a hole, right? So sunk costs by definition don't necessarily need to be worth as much as it is on face value, let's say. But okay, we know where they are. I mean, it's because it took a lot of time apparently to figure out the geology, let's say, because it's a somewhat unconventional play, in the sense that this is a historic high-grade mining camp where there's very high-grade veins, but they tend to be, let's say, narrow. But they have, I think it's a feasibility study even. Phase 1 initial capex 137, all-in sustaining of US 968, which is great. I'm actually surprised of how low it is. Resources, wait, what is? I'm pretty sure they have 2 million ounces in reserves, and yeah, because here they have, okay, all-in sustaining cost here is like 1,600, so that's not like high margin. Well, at this price there's still $1,000 margin, so it's not like it would, if this is correct. And note that this is again, I'm pretty sure this is a feasibility study, not a PA study, so this should be much more accurate than a PA, all else equal. So base case, the project has a value of 502 at $1,700 gold, which is obviously robust. So it's like, it's on paper it's worth $500 million at much lower gold prices. So this conservative bird in the hand has a value of 502. A $2,000 gold has a value of 821. At spot gold, I have no idea. 300 difference here adds 300 million, and now it's like 600. So maybe it has 1.6 billion dollars of MPV at spot gold. The enterprise value is 200 million, 300 million market cap. But my point about this one, why I think this is actually interesting, is that it's unconventional. I mean, first of all, we can look at the share price performance. That obviously people are probably pissed off by this. You can look in the forum. There's been people who's sold out, and some sold out on the financing because it was a discounted market. That being said, it was a pretty hefty financing. So given that it's like there's not too much money flowing around, so if you want to raise that amount, you probably have to, to raise 10 million, they might not need to give that much of a discount, but to get in, the people that put in the 30th million and 40th and 50th, for example, they might have needed to sweeten the deal even more. But some people, that was the straw that broke the camel's back, in a sense. So you have what I would suspect sentiment discount due to the share price performance, and having that financing to a discount. You see how it sold off all the way down into tax loss silly season basically. You also have the tax loss selling season. Obviously this is a downtrend, so some people have probably sold due to tax loss reasons, etc. So you have a bunch of that going around. Then you have the fact that it's a bit unconventional. They're trying to do what they did with, for example, Canadian Malartic. They're looking at turning known narrow vein or high grade camps into bulk mines, bulk tonnage mines, and that's what they're actually doing right with this as well, because the grade is around 3.7, but if you look at the actual veins, they tend to be much higher than that. So they're plan to, as you can see here, it's like have a big stope, and even though pyrite hosted in coarse veins, I'm pretty sure these are this is the mineralization. So you have a lot of waste material, sandstone, low density material, unmineralized waste, right? So these themselves might grade, let's say 10 grams per ton, but there you want to do bulk mining methods, so the overall grade goes down, but so does the cost of mining this stuff, because long hole open stoping is much cheaper than selective mining, for example, or narrow vein mining. So they expect to, lower grade, but much lower mining costs. So it's like, is there a guarantee that this is gonna make sense? No, they're doing bulk mining now. They've done like 1.2 kilometers of underground development, so they're down in the actual ore body. They're also trying an ore sorter that's hopefully going to reduce the waste by 50% or something. So it basically is supposed to throw away all this black unmineralized stuff here. Which draws down processing costs, because you're not having to grind and do all the things you have to do with the ore, with this unmineralized stuff. So it costs money to crush this unmineralized stuff. It takes money to truck it. It takes money to whatever and whatever. So if you can just not spend cost on processing stuff that has no gold, that's obviously great. That means lower costs. And the thing, what I kind of really like is the fact, this just got permitted. This got permitted in December. So, like the CEO says, this is one of few shovel-ready substantial gold projects in North America right now. So, there's not too many. And obviously it took them years to get it permitted. So it's like that's sunk cost. If you find the same, to get to this stage, if you would start today, they would need to, if you redid their steps, it would take them 800,000 meters of drilling, which probably costs hundreds of millions, and you would have to wait X amount of years to get it permitted, and without guarantees that it would even get permitted, etc. So there's a lot of sunk time and sunk costs into this project, and again, it doesn't really matter unless it's worth something. But on paper, it's worth at spot gold maybe $1.5 billion. And the idea is that this could turn into a camp because they have an absolutely insane land package. Well, first of all, they showed the potential depth. They're only down to, I think, 350 meters on average or something. And obviously these load gold systems can go down much more than that. They believe they have around, 14,000 ounces per vertical meter. So if they extended all known zones down 100 meters, that would be an extra 1.4 million ounces. And I think, what did they say? I think the CEO said, they reckon they can, for $20 to $30 million, they can add 1 million ounces of gold. And that, if those are economic ounces, that's obviously a pretty good payoff. Let's say they add 1 million ounces of gold, and that's worth, heck do I know, 300 million to 300 million, and they pay 20 to 30 million for it to prove it up. That's great, especially of course if they get it into production. But the thing is that it's kind of a district scale play. This is 4.4 kilometers of strike, known gold here, and then they have this Proserpine mountain, and I do believe this is gold in soil or rich rock chip samples, whatever. And this is basically, if you take away I think this is the main resource. This might though be in the resource anyway. So it's basically open at depth and could go much deeper, and then you have like 10 kilometers of strike to test with what I assume they believe is just going to be repetition. So what are they finding here? They expect it to go down at depth and might just keep going, repeating itself for who knows, like 15 kilometers or something. And then they also have that's 15 kilometer scale bar, so it might be even longer than that. And then they believe there might be a new parallel trend. And here you can see the camp scale comparisons. Like this is their land package, this is the Valdor mining camp, and this hosts 110 million ounces of gold. So they actually have just an enormous land package. So obviously if there would be like 50 million ounces of gold here, this might be producing for a long time. I'm not saying there is, but what I am saying is that, okay, we know again the price, 307 million CAD, 100 million in net cash, 200 million enterprise value. You're buying a project that's worth over $1 billion at spot gold on paper. Then the question, because it is kind of unconventional to have these high-grade veins being bulk mined, there's obviously a possibility that, okay, on paper it looks fine, but it doesn't work out for whatever reason. So that's why they're doing bulk samples. They're down into the ore body right now. That's also sunk cost, obviously. They are doing bulk sample exercise for 10,000 tons. So if that reconciles with what they expect, based on the drilling, etc., okay, that would be a major positive, obviously, because in that case, it looks like, hey, that's, pretty much proof of concept. That's like, yes, this idea of, what the high-grade veins got, and then you try to bulk sample and do it like, in a proper mining scenario. And if the grades are on par with what you expected them to be if you just took everything in bulk, unmineralized plus high-grade mineralization, then, the feasibility study might indeed be correct. And this is a, $1 billion plus project. And if that's the case, if they get proof of concept that we can actually economically mine this, and especially at, let's say, decent to good margins, I mean, then that opens up for the extension potential, because if they can mine this and it continues, then they should be able to mine this, let's say profitably down to whatever, 1 kilometer, I don't know. And if they can add 1.4 million ounces per 100 meter, for example, I mean, then it could get much bigger. And if they can mine all that, there's a pretty okay possibility that it repeats here. So you add even more, and then that could go down at depth, whatever. And then if you've shown all that, I mean, now I'm talking many years out here. But it's like, that's my point, is like the impact of like proof of concept. Because obviously if you can't mine this profitably, it doesn't matter if it goes down 2 kilometers. If you can't mine this properly and it just keeps on repeating, it doesn't matter if it keeps repeating, because if you can't mine this profitably, you probably can't mine the same thing over here profitably. So it's like, that's a huge torque on this, let's say. No, I mean, it's going to be obviously even more torque if they get into production and show it, but it's like the bulk sample is going to be probably a pretty big de-risking thing. And the ore sorting as well. Do they need ore sorting? I don't know. I think it's probably included in, I don't know if it's included in the feasibility actually. But point is, the reality is it's selling for 370 million. They have 100 million in cash. They're planning to do a staged approach. They're de-risking it. They have a phase 1, which is going to be turning to a phase 2, and the phase 2 would become up to, where is it? Like 200,000 ounces of production, and then we're talking a pretty good mine. And if it extends at depth and whatever, and grows even larger, then they have a very long-lived 200,000 ounces per year mine. With hopefully good margins in Canada and a huge land package. And they believe that, I mean, he talks about it as like, they hope that they can prove that it continues at depth and make some other discoveries along strike, and this could turn into a 500,000 ounce per year producer down the line, which would put it in exquisite company. And such a mine, I mean, a 500,000 ounce producer mine would probably be worth billions. I mean, the $200,000 mines with 200,000 ounces per year mines with relatively crappy margins and low mine life. I'm talking about the Newmont sales recently, the Musselwhite and Elinor, who have like 1.5 I mean, they basically had the same reserves, at least 1.57 million ounces of reserves, and in this case this has 2 million ounces. So this is wide open, unlike I would think Elinor and Musselwhite, but they got sold for $1 to $1.3 billion. And assuming the feasibility translates to reality, once they reach that kind of production, this should have a $1 billion plus market cap, obviously. And by that time, because there would be so much proof of concept, they probably would have done a lot more exploration. So in a sense, it might look like, oh, well, yada da, okay, we go to 2029. So that's like, 4 years from now? And it's like, oh, they have a $1.5 billion market cap. And you might think that's like, well, okay, it's at 300 million now, let's add some dilution, let's say it's up to 400. It's like, oh, it's only a small quote multi-bag or whatever. But at that point in time, they would probably know if they could push it to 500,000 ounces per year. And at the same time, they might have discovered and proved this is a 10 million ounce deposit, etc. And that's probably something the market would be pricing in already. And let's face it, I mean, look at Alamos Gold. I mean, they're ramping up, I'm pretty sure, but I think they're producing like 450,000 ounces per year right now, and they have a $10 billion market cap. So this is in a sense, I mean, stuff like this is, as an owner, that's that perspective is the most intriguing, because let's say it's like there is a possibility they put this into production, and this is turns out to be a 10 million ounces plus, like 10, 20, 30 million ounces camp. And it's like that might be known, let's say that's known in 10 years. And in 10 years, these guys are producing 500,000 ounces per year, and have whatever. Yeah, again, I'm theory crafting here. Let's say I'd have like 20 million ounces in reserves and resources, or 15. I mean, that would probably, especially if they're able to show that it's, pretty good margin as well, that's probably gonna have, well, I don't know what the gold price is gonna be, but let's just take it in real terms, like today's terms, several $billion market cap. And let's say that could keep going. That could just be producing whatever for a long time. So it's like in 10 years, just imagine that's like, oh, the free cash flow coming out of Osisko Development is like, whatever, $400 million. I mean, again, just making up numbers here, but it's like, oh yeah, I bought it in early 2025 for 300 million market cap, and 10 years from now, it's like pushing 400 million in free cash flow per year. So it's like it has a future market cap divided by free cash flow, like under one. I mean, that's an kind of exciting thing. I mean, I don't think that's gonna happen, because I think they will have been bought out by then. But just the idea of like theoretically buying a multi-decade gold camp basically for 300 million, that's a very enticing proposition to me. And then they also have the Tintic project, and that's also one thing about that is I think it was a pretty costly acquisition. I'm not sure they've actually paid for the whole thing, but I think the deal was like, if I'm not mistaken, it's like 100 million US or something. I gotta look into that even more, because my idea was like, okay, what is Tintic worth? I mean, they're drilling right now for another Bingham Canyon. I mean, it's basically them, Ivanhoe Electric, who is exploring this Tintic district, and Tintic is famous for having one of the largest CRD systems. I mean, I think Sean Rusin said that this is the second most mineralized area in all of Utah or something like that. The Bingham Canyon area being the top one. Bingham Canyon is multi-billion world-class mine, and had I think CRD systems and skarn system, and I mean basically that the Bingham Canyon system probably I mean laid the foundation for, well, first of all, one of a world-class multi-billion-dollar mine, but it's like several, I mean many smaller mines as well. So they have very high grade epithermal mineralization, they have CRD potential, and they're drilling for they have two big, I think these are the big okay, this is CRD potential, here's the porphyry. Yeah, so they have two big porphyry targets as well, and that's basically what Ivanhoe Electric is looking for as well. So it's like, you're in the right neighborhood, because Ivanhoe Electric is here, and we know that Robert Friedland has and his team have made a few multi-billion-dollar discoveries. So they obviously think there might be a big porphyry here. Then the question is, I mean, the porphyry might be down here, because this is what Ivanhoe has. But they've hit porphyry mineralization in some previous drilling here, not hit a bullseye. But there appears to be porphyries here as well. It's like, is there an economic porphyry worth billions of dollars? I don't know. Where is it? Is it all three here? Is it zero? Is it Ivanhoe's? Is it this one? I don't know either. But just looking at the terms of the deal, plus you add then the epithermal potential, whatever. So it's like, even if you add whatever, let's go half the deal cost. Let's put 50 million CAD only on the Tintic project. that you're getting that. Not that it's necessarily gonna get monetized, because if I mean they probably could make money on their Bonanza Gold stuff. And you can look through the news releases. They've hit some, I mean, pretty incredible holes, as you can see here. Absolute bonanza. Not huge tonnage, but they should be obviously be making should be able to make money on that. And I'm pretty sure they have ramps already, down into this stuff. So they should get some money out of Tintic, I would think. But they're also burning money on exploring for especially the porphyry stuff. But let's say 50 million CAD to it. Okay, then I mean the enterprise value for the rest of the portfolio is down to 150 million today, which makes it look even cheaper if you look at the Caribou Gold project. And then they have San Antonio, constructed a heap leach pad and a carbon column plant at end of 2021 to process stockpile mineralized material. So that's like 543. Well, okay, they have 577,000 indicated, so around $1 million ounces. Let's say 500,000 of, I don't know if this is maybe, I'm not gonna say it's sulfides. And they have actually, I mean, produced some gold from this. So now they seem to have, it's being the Mexican angle here. Well, I don't know what this could be worth, but 500,000 ounces, I mean, at spot gold, if they could produce 500,000 ounces at, okay margins, I mean, let's say it's worth 100 million. I don't know. I absolutely have no idea. But let's put a 30 million CAD value on this. So that's Tintic 50, this 30, then we're up to 80. In that case, you're paying whatever enterprise value of 120 million for the 5 million ounce reserves and resources Caribou Gold project, which is just an enormous land package that theoretically could become a multi-decade mining camp if things go well. That's pretty darn cheap, especially with gold being where it is. Is there a guarantee that this will happen? No. Do I think this is actually a pretty good HODL candidate? Yes, I do. Why? Because the pipeline for growth is obviously enormous. With this kind of land package, this amount of targets, the deposit is already a multi-million ounce system, which could be enough to mine for a few decades, let's say. But then the thing, obviously, the match becomes the proof of concept. Let's say the bulk sampling, the initial mining, the ore sorting, etc., etc. So basically, if this works, it could work very well. So I guess it makes sense if you're even less, more risk averse, you'd wait for the bulk sample. Because if the bulk sample exercise is like terrible, it's like the grade isn't even close to what they thought, well, then we might have a problem. Then this idea of bulk mining this stuff might not work out, and basically you can maybe scrap the whole thing, I was gonna say. But if it proves out to be reconciling well with the resource model, for example, then it's basically game on. Hey, in that case this should actually be worth along the lines of the feasibility study, and it's fully permitted, it's shovel ready, they have 100 million net in cash, they have a stage approach, and I think the initial capital expected to be quite low. Where's the phase one? Initial capex, 137. So I guess that's to get this up and running. So they could, according to this, they're supposed to be a 26,000 ounce producer this year already. Is that going to happen? I don't know. But then already 74. So let's say they make decent margin on 74,000 ounces, and this is a mine life for like 30 years with that throughput. Maybe it's, just in this scenario, it's gonna make the current market cap look cheap. If you account for for the let's say whatever free cash flow, mine life, jurisdiction, obvious pipeline for additional exploration. So I mean, again, a hodl case is where it's like, okay, let's say you buy it today, you come back in like whatever. The longer the pipeline, I guess, the better. You come back in 4 years. Okay, what's the risk reward in that scenario? Well, they could be, let's say, according to plan. So they're here or whatever. And they have proof of concept in all kinds of things, much bigger resource, maybe a discovery at Tintic, maybe not. Maybe they sold or put the Mexican asset into production. They're making good cash on Caribou. It's obviously 10 million ounces at this point in time. They're ramping up to 500,000 ounces. Yada, yada, yada. Obviously, then this company, assuming we have somewhat similar margins like the gold space has today, this should probably could be trading at for billions of dollars. That's a pretty good picture. And let's say you fast forward 6 years, and it's like, well, now they're up to whatever. Let's say they're up to actually 500,000 ounces per year, and it's like it's 20 million ounce endowment or something like that, and it's like, oh, it's trading for $8 billion or something. Then you obviously made a shit ton of money in 6 years. Or nothing goes well and they shit the bed, this project doesn't work at all, they find nothing else, so you lost money on the case. I mean, there's obviously a million different scenarios in between, but you have the Osisko group backing this. Osisko Gold Royalties have like 40% of it or whatever. What is the Osisko group famous for, I was going to say? Well, proving up multi-billion-dollar mines that get sold for multi-billion dollars, and they even put Canadian Malartic into production. They know what the majors want. They know what a economic mine looks like. They go for district scale opportunities basically. They go for multi-billion-dollar paydays, and they know how to build mines. And I do think that they have the access to capital to get it to being built, let's say. Otherwise, obviously, if you had no access to capital and didn't know how to build a mine, I mean, these projections don't really mean anything, because you're not going to raise the money to even put it into production, and if you do raise the money, you might screw it up. So just the fact that it's an Osisko company, they're famous for other things like a lot of dilution. But thankfully, at least 800,000 meters of drilling has already been done, so that's at least in the bag. Anyway, I think this is a very interesting case, and also along the lines of bird in the hand plus, in a sense, on paper, a lot of free optionality. It's in Canada. This one is actually fully permitted now as well, so one should, I mean, except for the somewhat unconventional way of turning this into a bulk mine, on paper it has then an incredible amount of margin of safety, because it is fully permitted. So if these economics are correct, then this is simply cheap. Yeah, that's all there is, and it could become worth a lot more. That's the thing. That's the risk reward here. Anyway, so yeah. I mean, I'm not saying you to buy. This is not a huge position for me, but it's like I am very. It's kind of along the lines of, let's say, First Nordic, where it's like I feel like there's a possibility to buy an entire camp basically for much less than what's already, what only the flagship mine in that camp is worth. And it's in a tier 1 jurisdiction, so I don't expect to wake up one day it's getting taken away or something. No, basically, if you could buy assets like this 100%, like personally you buy up the entire company, yeah, I mean, theoretically you could own a gold district that, let's say, produces gold for 50 years, and you bought it all for 300 million in 2025. I mean, as an owner, that's like appealing. Not looking at it like, I'm gonna flip this stock necessarily. But it's like, would you actually be happy of owning this personally? Assuming you know, had a right team. It's like I obviously wouldn't be able to build this myself, but you know what I mean. If I could buy this company with all the people and the competence and whatever, for 300 million, and I get $100 million in cash, and you get, you know, Tintic and the Mexican project as well. If I turn that, I mean, from a business side of things, could that be a very profitable investment? Yeah, I think it could become that. Anyway, thanks for listening. Consider me biased. Amex and what did I talk about? Brixton. Well, at least Amex is a banner sponsor. I own shares of all three companies. Consider me biased. Not investing advice. Don't invest money you cannot afford to lose. I don't share your profits or your losses. Don't buy anything if it doesn't make sense to you and you have a, you know, idea why you bought something. Because let's face it, I mean, if I might be, let's say, buying all three, it's like today. If I find something that's even cheaper or whatever, I could be selling it tomorrow. So that's my point. It's like, you have to know why you bought it, etc. Now I just happen to know that, or happen to think that for different reasons, I think they're very interesting. I mean, obviously I would consider Osisko Development and Amex to be much lower risk than Brixton Metals. Brixton Metals obviously have that reward side torque, but it's much more speculative in a bunch of ways. Yeah, anyway, thanks for listening. Bye, guys.